Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video I want to share with you why my wife and I have been investing heavily through an exchange traded funds and not really going through stock picking anymore. We have been investing in the market for the past 7 years, and in fact, when we first started, we started by choosing individual stocks, whether it be REIT stocks, stocks in different sectors, as well as picking any random stocks that was hot at the time, and really learning our lessons along the way. Over the years, as we did more research, as we really look back into our own numbers and our performance of individual stock picks, we really started to realize how we have actually followed that path to our own detriment. Had we just simply picked broad market index funds or broad market exchange traded funds, we would have been able to not only keep the cost low because we would have avoided a lot of frequent trades, but also we would have actually ended up meeting the market returns, which in many cases would have been a lot better than our individual returns that we had when it comes to overall looking at our portfolio. Now, of course, I'm not going to say every single stock that we picked was terrible. No, we had some really good successes too. There were individual stocks that we had really, really nice returns on. But the challenge and the problem is in many cases, it's very, very hard to continuously pick winning stocks and repeatedly accomplish that over time. It's really, really hard. And in fact, rarely investors are able to maintain that for a long period of time, which is why we ended up switching our approach in investing about a year ago to selecting only a few broad market index funds. Majority of our funds, if you look at it, close to, I would say, 91% of our holdings are in one single ETF. It's called XEQT, iShares Core Equity ETF portfolio. As the name suggests, it's a very broad kind of ETF that is consists of all-in-one holdings. Through XEQT, which is offered in Canada, we are getting 100% exposure to stocks. And this gives us exposure to stocks in Canadian market, in the US market, and international markets. And by international markets, it comprises of both developed international markets as well as emerging markets. So it makes things super simple. By holding on to this one single ETF, we are getting exposure to close to 9,000 companies worldwide. And that's one thing to keep in mind. Sometimes I've had questions on Blossom app or elsewhere, folks asking me, well, how are you diversified if you're just putting over $500,000 in one single ETF? How is that diversified? And the answer truly is that even though it's one single ETF, it's a combination of multiple other index funds and give you exposure to the entire world stock market. So really, it's a super diversified fund in that regards. Looking a little bit more at the specifics of XEQT, as I pointed out, it's a simple and efficient way to gain exposure to a portfolio of ETFs that is broadly diversified across regions in one convenient package. All of that for a very minimal fee. If I show you real quick, it only has a management expense ratio of 0.20%, which is really, really minuscule for all the benefits that you get, including the most important of all is the automatic rebalancing that is done through this ETF for you. Year to date, this fund is up by 8%, quite nice. The fund was incepted back in August of 2019, August 7th. So in less than a few months, it would hit that 5-year time frame, and you would be starting then at that point to see the 5-year annual return for the fund as well. Right now, you can't see, but if you look at the cumulative return since its inception, it's up now by close to 66%. I want to also bring to your attention, as I pointed out, the number of underlying holdings closer to that 9,000 different companies worldwide with a 12-month trading yield of just shy of 2%. The XEQT consists of 4 other underlying ETFs. In this case, all of them are being index funds. One is iShares Core S&P Total US Stock Market, ITOT, which is available actually here. Then you get exposure to Canadian market through XIC or iShares S&P Toronto Stock Exchange Capped Composite, XEF iShares MSCI East and Far East IMI Index, and lastly XEC iShares MSCI Emerging Market ETF. If you were to buy these individual holdings separately and have them weighted according to what you see here, you would definitely save a little bit on the management expense ratio, but what you would be lacking on is the fact that you would then have to continuously monitor its weightage as the value of these index fund ETFs goes up and down, have to rebalance it yourself. Might save you some dollars in terms of cost, but down the road, I believe it actually brings a little bit of extra work and legwork for you as an investor, which is why for me, I'm super comfortable with just holding on to shares of XEQT as our major holdings. Other than that, we have 2 other holdings, VT and VTI. Honestly, if you're a new investor, I wouldn't necessarily recommend it for you. for us, for my wife and I, because we have a larger portfolio size, we wanted to try to minimize the effect of the withholding taxes for our funds and for non-Canadian funds in our RSP account. That's why we are holding shares of VT and VTI, which are both in USD in our RSP account, registered retirement savings account. That said, though, there are some costs involved with that, because whenever we were to buy these two, we had to first convert our Canadian dollars to USD. At the end of the day, it might not be worth it if you're just starting out, or if you are planning to hold on to these funds for a short period of time. For us, we did the justification in our head that, you know, we are gonna buy these shares of VT and VTI, hold on to them for the longer period of time, at least the next, I would say, 8 to 10 years. During this time, we are going to save a little bit on the MER of them as well. VT and VTI have a lot smaller MERs too, and plus any dividend that we get from the shares of VT and VTI, the US portion of them are exempt from that 15% withholding tax on the US portion of the dividends. You have to really do the math over time. It may pay off, but honestly, in the short term, I don't think necessarily it does, because you have to also take into account the cost that you are paying for converting the Canadian dollars to USD. And of course, even back from USD to Canadian dollars when you are selling it to use your funds. Really, those are some calculations for you to keep in mind. I know I have a lot of colleagues and friends as well on Blossom app, like KYT is one of my close friends there, that he only invests solely in XEQT, and he's kept it super simple, regardless of the account that he's investing in. And I think, honestly, that's a very good approach. Highly recommended that approach as well if you want to keep things simple, just holding on to one single all-in-one ETF. If you are the type of person that maybe are a little bit risk averse, and possibly you want to have some sort of exposure to fixed income, the bonds portion, you could consider other alternatives such as XPAL or even XGRO. With XGRO, you're getting 80% exposure to stocks and 20% is exposure to bonds. And as we go through the rest of those all-in-one funds, you lower the exposure to stocks and increase the exposure to bonds. For now, we've considered only 100% exposure to stocks. One of the key reasons is that, for me at least personally, because of my work, I am getting a pension after I retire, hopefully in the next 10 years or so, and I have a defined benefit. Because of that, it's a DB, it's not a defined contribution, but defined benefit. To me, that's a guaranteed income, and that almost accounts for a bond portion of our portfolio, which is why I've opted to take a little more risk and have 100% exposure to stock market because of that. I've recently read the book, Reboot Your Portfolio. I talked a little bit about some of my key findings from that book. I borrowed it from library and recently returned it after having finished the book. Highly encourage you reading that book. It talks about the perks and advantages of holding on to a simple portfolio through investing in broad market index funds. It also talks about why some exposure to bonds may be beneficial. Again, you don't have to take every single word of that book word for word. You have to, of course, internalize it and see how it applies to your situation. But I do definitely encourage you to read that if you haven't checked out that book. And you can easily borrow it here in Canada from a library, as it's available there for your reference. With that, I hope this video was beneficial to you. Let me know what your thoughts are, and if you have any question for me. Thank you so much, everyone, for watching this video until the end. I hope to see you all next time.